Hi, everyone. I'm Rick Bensignor. Today is Tuesday, November 30th, and welcome to this week's In the Know Trader show. As we start off, the Dow is now down 500 points, and another washing out as Fed Chairman Powell and Treasury Secretary Yellen have addressed the Senate Banking Committee, and just, I guess, within the last 20 minutes or so, Chairman Powell said some things that were looked at as being hawkish, and the market took a dive. The NASDAQ had actually gone positive for the day after opening significantly weaker, and now it too has dropped, and the S&P is down, I don't know, 65 points or so. So it's going to be another rough and volatile day. In this week's show, we're going to talk about exogenous events in market history. Exogenous events being things that kind of hit the market that come out of left field, things you can't plan for, kind of like the Omicron announcement of last week, and seeing what the market did on Friday. In our market overview, we'll take a look at the Dow, the US 10-year, and the dollar. And then I thought it made sense this week to kind of look at the 11 macroeconomic sectors of the S&P just to get a sense of what's going on within each of these major groups, to get a sense of what's doing well, what's looking weak, what is breaking down, and what's still doing decently. So we'll go through the 11 SPDR sector ETFs. As a weekly reminder, we publish a weekly ETF Tactical Trader report. That report gives you a macro overview, much more in depth of what we do here in the show. We go deeply into key S&P levels, as well as often the 10-year, gold, the dollar, credit spreads. And then we give you a new ETF idea to trade each week and update everything that we have, all open trades, until they get closed out. So every week, once we put something on, it could last for months, it could last for weeks, but we will walk you through that trade and update. Often we will trail our stop outs and move them higher as if it's a long idea, as the market moves higher, to protect profits. Or to hopefully minimize losses. We also do a 7-11 monthly report, and we've got a brand new one coming out today because today is November 30th, and it's the end of the month. So we put out this report with the goal of beating the S&P 500 through the SPDRs. So that is our benchmark, and we will be invested in no more than 7 of the 11 SPDR ETFs that will in fact go over in a few minutes when we get to that portion of today's show. But we, of course, are looking at these in relative terms. So we're looking for the outperformers and to avoid the underperformers. In order to beat the S&P, we have handily done so this year, both in the sense of our fiscal year for this particular report. It starts every August 1st. We're up, I think it's about 1.25% since August, and since August of 2020, when we started this report. So that's about, not including the new results we'll publish today, but through October 31st, we've outperformed by 4.44%, purely running a portfolio of these SPDR ETFs to beat the actual SPY itself. And that is, if you know anything about money management, you will know that 4.44% in 16 months or so is a huge outperformance. This is for individual investors. It's for certainly financial advisors, rather than simply being in some model portfolio that their company publishes, or RIAs don't even have access to that typically. This is a very easy and cost-effective way of beating the S&P over time, and with most likely far less volatility than the S&P has too. So all these available at intheknowtrader.com. Go to the website, go to the sign up tab, and that's where you can get prices and sign up for this. My email, rick@intheknowtrader.com, best way to get me. Okay. Let's start off with trader education. So exogenous events, as I mentioned in the opening, these are things you can't plan for. That's by the very nature of the word exogenous. They just occur. So they are far more difficult to, you can't minimize or hedge your portfolio, lower exposure in anticipation of exogenous event, because by its very nature and definition, you can't plan for it. And I think Omicron is a good example of something that kind of just comes out of left field. The market was closed last Thursday for Thanksgiving, and of course Friday was the disastrous down day. And these are things that happen occasionally in the markets. They are rarely to the upside. They're almost always some negative thing that impacts the market very quickly. And we all saw what happened last Friday. And then how to deal with it, what to do. And the reason it's important to look at market history is to get a sense of when these things happen, what generally happens in the market, because markets do tend to repeat themselves over time, and investors tend to repeat their same actions over time. So it's always important to understand market history. And what we know from the past, and let's just take stuff, let's say in the last 30, 40 years, the crash in 1987, when the Dow fell, if I remember correctly, 23% in a single day, which is still far more significant than any crash we've had since then. But as I told in the No Trader clients in this week's report, that actually, because the holiday was on Thursday, I didn't publish the report until Saturday. And what I said to them is that these type things are usually not one-day events. And despite the fact that the market recouped so much yesterday, Monday, here we are back down again on Tuesday, and and down big. And you're going to see this, and you shouldn't feel that you missed the opportunity, like on Friday, not on Friday, yesterday, Monday, to have been a buyer. Unless you're a day trader, chances are whatever you bought yesterday is already down money today. And this is why it's important to know market history, because these are not one-day events. These things that kind of just implode a market tend to stick around for a while. And I'm not saying it's daily implosion at all. You can see we have huge down day Friday, huge up day yesterday. Right now, significant down day, 1.5% or so in the market today. These are big moves. And of course, 500 points in the S&P, I'm sorry, in the Dow, when the Dow is trading at 35,000, is very different than the Dow is trading at 5,000. So percentage-wise, these become smaller and smaller moves. But nonetheless, these are, anytime the market moves more than 1% to the day, it's a decent move. But when you get to 2%, it's really significant, and so on. So I think the most important thing to kind of look at and understand when you've got these events is that the market is going to have increased volatility, that you'll usually have multiple chances to do what you want to do. It may not be exactly at the price you want to do it at, but these type things will shock the market. You'll get your initial reaction. You'll get counter moves in both directions. And the best thing that you can do probably is, if you are a trader, is to trade some of these moves. And sometimes it will mean cutting it down to intraday or 2-day trading because of the significance of the moves. If you're a swing trader, you're going to have probably to cut your time frame down, because nobody really is going to know how much this is going to affect things going forward. But we have a little sense of history also from last year when coronavirus first hit the market. And we knew back as early as December of 2019 that there was an issue in China, and slowly it started spreading globally. We didn't know how bad it would be, but eventually, as this hit the shores of the U.S., people started to, when this impacts your own personal, some news impacts your own personal health, your family's health and well-being, people are going to get very emotional about it. And when emotions start controlling markets, you're going to see very erratic moves. So understand that when we get news like we got on Friday of a new variant, that even was it yesterday or this morning? No, that Moderna said, even booster vaccines are not going to fully insulate people from this new variant. That you're going to see markets all over the place, and you'll have plenty of opportunity to do what you need to do. And again, don't get stuck about 1% or even 2%. If you want to lighten your portfolio because you think this is going to be a significant event going forward, you still can do it. The S&P is not all that far down from all-time highs. Put it in perspective of a market that was up, I don't know, S&P was up, 23, 24%, something like that on its highs this year. And that's a year that we've already had to deal with COVID earlier this year, certainly last year, but even into the beginning of this year, and you still had a monster year. So, play accordingly, understand that these things can last a while. And the most important thing is that these type of events, and I remember back in, what year was it? I think 2011, where I was at a Wall Street firm as their strategist, and the Japanese nuclear power plant at Fukushima, exploded and the market got hit. And I commented on it and I said, this is not going to be a short-lived thing. This is going to stick around, and the ramifications are going to be felt for a while. And, I got some pushback from some of the other people in the firm saying, well, you're a behavioral strategist, you look more at technicals. What do you know about, exploding power plants and ramifications? And I said, I'm a student of the markets. I know what happens when these things happen, and they don't just go away and have no effect. So it's not a one-day sell-off and that's it, it's done. So, put this Omicron, whichever way you want to pronounce it, put it in perspective of what we've seen from COVID, from the Delta variant, and then, now from a new one. And it's not to say it's the last one, who knows? What it does make me feel is that this type COVID-related issues are here to stay for a while. And we're not, we handle it. I think both the Trump presidency and the current Biden administration, the rush to get vaccines out was admirable, and we're doing what we can, but we're going to have issues from this for a while, and it's going to affect travel, and it's going to affect work from home and lots of other things. And there's going to be opportunities in the market, even on a day like this. Apple's up $2.75. Tech continues to do well regardless of what's going on, and we'll talk about that shortly when we get to the XLK. But there are going to be opportunities, and which means that we've already addressed this as traders, but for investors, you have to stand back a bit and put this into the context of, does it pay to lighten exposure in your portfolio, or do you just want to sit through whatever this variant does to markets and the economy, and potentially any other ones? Because, even with Delta, we obviously came back enough to post new all-time highs. So, is this something that for the next few months could increase volatility of the market and then just 2022 trucks on to the upside, or maybe not. Those are decisions you need to make when we get these type exogenous events. Just realize it's not one and done, and it's not a one-day sell-off of 1,000 Dow points and 100 and something S&P points, and it's all done. It's not. It's going to be volatility galore until we get better sense of what it is, how bad it's going to be. And to my knowledge, we don't have a case yet in the US. There are already in Canada. And once, it crosses borders and comes here in the US, yeah, people are gonna, this is gonna scare people again. And until the pharmaceutical companies get a handle on it, and what can be done, it's another issue that we all have to deal with. Okay, enough about that. Let's take a look at markets. We'll start off with the Dow. So here's a chart in real time, excuse me, of the Dow Jones. So in Dow terms, this week has a lower low than last week, right? So last week it got a little bounce off of Friday's low, but we are beneath it. We made a new all-time high, and obviously look at what's happened here since we made the new all-time high a month ago. If I were to change this, I know how to read candle charts, even if they're in basic bar charts. Weekly close less than weekly open. So even on the week that you made an all-time high, you closed lower than the open, and you closed lower than the prior week. What do we do the following week? Open slightly higher, close on the low of the week. Next week, open slightly higher, attempt to rally. This is last week now, so this is when Omicron hit, close near the low of the week. Open higher again. Right now, it's only Tuesday, but we're lower. That's not a good sign. That's kind of new high failure, and you're back underneath the prior highs. I give that kind of a failure type of look to what had gone, the fact that we're beneath what had been the highs from the summer before we had the sell-off in September means to me we're probably still heading downward. This yellow colored box is where I see the support going forward for another month or so. You've got one major trend line. You've got where we bottomed, which was the TDST line. So in September low, we came back to the lowest low of the most recent 9 count up. That was bar 4. Usually it's bar 1 or 2, but this time it was bar 4, made the lowest low. That shoots out this dotted TDST line, and that's where we stopped on the September sell-off. So we're probably going to come down into the zone and test it again, and possibly even break these two trend lines and test with the top of the cloud, which for the next couple of months going into January stays fairly steady at about 33,360. Lows down here are 33,270. That's only 100 points away from where this is. So we can even say, let's just take a look at a prior low and say that, do this again, there we go. So this zone in here is pretty important. It's got all the lows over the last since the June bottom, as well as trend lines, the TDST, and the top of the cloud. So that's probably where we're headed to over the next weeks, month. It's not necessarily we go there in a straight line, but at this point, seeing the pure selling that we've had since we made new highs, and this is before obviously this new variant came out, that's an issue here. Let's take a look at the US 10-year. Here's the weekly chart. So we've shown this to you, many times. After getting the lowest low was on a setup 9, followed by a 13. That's where we called the bottom in rates. We moved up. We topped somewhere near 10 basis points or so higher than when this 9 came in. And then we do a 9 down. Then we do a 9 up, and that's the high. So the 9s have been great. And, we're kind of in between here, tougher call. Notice we've been bouncing. I tend to keep trend lines that have broken. In this case was a channel line. I tend to keep them, actually this line itself should be, well, I'll take care of it afterwards, but this line should be dotted too because we broke beneath it. But I tend to keep these on my charts because, we've already bounced off of it once, and this week, again, very close to the low from a few weeks back, and we're sitting at 147. Obviously, you've got an important trend line coming off of these lows here. You've got the Fibonacci box in here. So this is, the huge support level for yields. And of course, this is TNX. So this is yields. Move the decimal point 1 over to the left, and you'll get where the US 10-year is trading. So right now it's at 1.468%. So, you're kind of, there's no particular trend over the last couple months here. It's sideways, but we've got double tops on 9s and a 9 count here on the bottom. It'll be interesting to see whether or not there is more of a flight to safety, which means people buy bonds, and if they buy bonds, they're selling. The yields are coming down, so it'll be interesting to see how this develops. But that's the picture that we're looking at now. And the dollar index probably spiked up today on Powell's comments, but I'll show you, into an area. So, we've been calling for a top in the dollar in between 96.5 and 98 or so. So I've got a propulsion upside target at 96.62. The top of the Fibonacci box is, I don't know, just shy of 97.75. Or something like that, and we've got a 9 count here. So we perfectly called the bottoms here in the dollar. We've told you all year long dollar was going up, other than one tactical trade where we were shorting it, but otherwise we've said the street has this call wrong. They came into this year the most bearish of any macro market. Was bearish the dollar, and in the first week of January we said the dollar is going up, not down, that the street's going to have this wrong. And we just made highs for the year over the last 2 weeks. Up in here, I'm starting to think that this is getting tired, both between the 9 count and into the Fibo box and the propulsion level, and where things broke down from in 2020. So right now, I don't think we're going back to the top of the channel. There is I'll bring in some more data. You'll see there's this massive channel here from those highs, and these lows go even farther back. So it's still in a huge channel. I don't think we're likely going back that high. So I'm willing to kind of bet against the dollar up until this area. All right, now let's take a look at our 11 macro sectors. We will start with XLB and just make our way through them alphabetically. So XLB is materials. Essentially, the high was made in May. We made a slightly higher high a few weeks back, along with a 13 upside exhaustion signal. Same thing, pure selling since. These are all negative candles. We're getting some minor support here. If that breaks, we're going to go to the top of the cloud and or test the bottom end of the range, which you can see is at this level here at 78. So new all-time high. That's faded quickly. And that's the picture here. So still in, upside targets, or if this holds and goes back up, 90.76, 92.96, and then 96.66 on the upside. Downside targets here, top of the cloud. Then these other prior lows and the weekly propulsion level at 78.05. And then even this down at 75.97. XLC communications. Look, exhaustion signal. This has been this topped in August, and this has been trading down. We've now broken through the propulsion exhaustion level. First, we'll see some support here from the top of the cloud. Otherwise, this has room all the way down. You're only on a 3 count, so it's possible that this keeps going lower. So there's some trouble here, and you can see that MACD is even widening out and making things look There's momentum picking up to the downside. XLE energy, 13 and 9, kind of sideways tops recently. Oil's pulled back. Omicron is going to affect some demand in some way, but this is this is not bad. Well above the August and summertime kind of lows here. We can even put a line kind of straight across there. So you've got multiple targets on the downside. You can, other than like propulsion, you can do, this, you put up Ichimoku, the cloud charts on any one of your charts too, to kind of come up with levels too, as well as obviously any horizontal lines. So oil's coming off and you're seeing the energy finally getting some profit taking. I still like energy over time, but certainly there's some near-term pressure. XLF financials, while they're certainly going to have trouble if interest rates don't go up, the street I dramatically lowered our exposure to financials over a month ago. They have underperformed badly since, and part of it were the 13th year, part of it was I didn't think that interest rates were going to go higher. We actually flipped our call and said that this is a very overcrowded trade. So that's worked out nicely for us, Chris. We took this down to just a tad above benchmark weighting as compared to significantly above. XLI industrials have been in trouble. In relative terms, they're quite poor. In outright terms, this chart still looks okay. If you break underneath here, you open up the door for a more significant pullback. But again, upside exhaustion signals, new all-time high that quickly fades. What are we up to? XLK, here's the biggie. So here is, we just made all-time highs last week. You've got a 13 signal here, but this is the best looking chart we've seen. Farthest above its cloud, farthest above the conversion baselines from the same cloud model chart, and way outperforming everything else right now. So tech loves a lower interest rate environment. XLP staples, pure sideways. It's gone nowhere. Tops there, tops there. So we're probably coming down to the top of the cloud. If that breaks, we're going to the bottom of the cloud. XLRE real estate, one of the better outperformers this year, sideways for the last 5-6 weeks or so, but double top against the old highs. And this is probably also going to get into some type of trading range. If it breaks out to the upside, look for 50.83 next. XLU utilities, sideways, nothing terrible underperformer, very close to the cloud. So there's nothing here yet to be in that space. XLV healthcare, lower high, did not make a new high recently. 13 on the all-time high, 13 on the subsequent high, pulling back, break. Let's see. So let's give this some support there. You break that, you're coming down to 121-ish or so. And what do we have left? XLY. Consumer discretionary, probably second best looking chart pure on an outright basis. New high last week. Also, like technology, above its conversion and baselines, well above its cloud. So that's your second best looking chart. And let's see now, probably. Yeah, I'd probably put support somewhere around 186-ish. And of course, these interim ones in between. That's it for this week. I hope you enjoyed the show. I'm Rick Bensignor, and this has been In the Know Trader.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.